open the gate. Super cross stands loud, proud, and true. Building tomorrow for me and you.
Hello, everybody. I am so excited for today's episode. We're doing something totally different. We're departing from all of our traditions. So be patient with us. This is going to be an important conversation. We've got Brian Belley with us today. Brian is the vice president of product at KingsCrowd, and he's done a profoundly important analysis. He published this recently, and I had to get him on the show to talk us through because this is so vitally important for all of us. So stick around. You don't want to miss this. Brian, welcome to the show.
Thanks, Devin. Happy to be here.
Well, we're thrilled to have you, and excited that you could be here. What you did in this recent article was to write up a really thoughtful analysis around rates of return on various debt structures and what is required to compensate for the risk at different stages of operation. And this is all data driven, right? You've sort of honed this with some real data. Can we jump in here? I'm just excited to get to the data. So let me see. I got to pull this up here. I want to show people some images, but this is a chart that shows investment returns or debt returns expressed either as a multiple of a revenue-based financing multiple or an interest rate for a traditional debt structure. Fascinating analysis. What does it mean? How are you interpreting the data here?
Yeah. I'll give a super high level intro of why I did this, right? Because a lot of times I hear a lot of investors understandably kind of look at the online startup investing, small business investing, regulated investment crowdfunding space where they see two buckets, right? They see these high risk, potentially high growth startups, and then they see some of these companies that are offering revenue shares and debt deals, interest rates. Now, I've heard investors a lot of times tell me, hey, I'm not for this high risk, high failure rate, potential high growth startup. I would rather just invest in a debt deal and get my returns. And that's great. And I think there's a lot of, value to that. What I think a lot of these investors miss, though, is that there's still a lot of risk in these deals. And so what I wanted to do was actually say, okay, assuming that you want to invest in some of these debt and revenue share deals, what is the actual interest rates and payback multiples that you need to compensate you for those companies that are still going to fail, right? These aren't necessarily the super high growth trying to be a venture-backed startup, but there's still a lot of risk in these. So what this chart shows is on the two different axes, you can see the basically the interest rate that would be required to kind of like compensate for risk and or the payback multiple. So if it was a revenue share deal, sometimes they'll be capped at 1.5x, 2x what you invest, meaning you can get back 2 times your initial, investment, and then it's settled. So what I did is take a look at the revenue on the x-axis here to say, okay, there's going to be companies that are of different maturities, right? There's some of these companies that are offering these debt notes and these revenue shares are pre-revenue. So that means they're not making any money yet. Those, understandably, are probably higher risk, right? And as the data actually showed, yes, they are higher risk. And so you need to get a higher return from those to compensate for that risk. So that's that first bar there where it shows that for pre-revenue deals on average to date, you need about an 11% return or 1.5x payback multiple. Now, I will kind of just make the disclaimer, right? This is broad. We're painting with a broad brush here. So this is, very aggregate level data, and it can vary very much on like the independent deal level. But to start giving you an idea when you're taking a look at one of these deals, that is what you're looking for. On the opposite end, right, if we go to the $1 million plus, so that bar all the way on the far left there, you can see that it's about a 9.7% interest rate will compensate for the failures that are expected there. And that ends up being about a 1.44x revenue payback multiple. Now, the caveat with the calculation just in that payback multiple, because obviously if you got a 1.44x return in 1 year, that's fantastic. That's a 44% IRR, right? So this was basically taking a look and saying, okay, what's the average term length across all of these deals for debt and revenue share? And then we use that for that assumption of what the payback multiple would be. So I believe it was around 3.9 years, if I recall.
Yeah. Okay. So relatively low payback multiples are correlated with relatively short payback timeframes, right? Those two go together, right? Am I understanding you correctly, Brian?
Yep, there's the payback multiple has the two components that make up it. It's the amount of the return, how much you're getting per year, and the time. So again, if you had a 1.4x return in 1 year, that's fantastic, right? 40% of your money in 1 year, that's very good. Versus if that was a 1.4x return over 10 years, that's actually a much smaller annual return rate. And so that's where it gets normalized.
Let's just take a quick aside here, and let me ask you to explain how a revenue-based financing deal works. Because interest rates on traditional loans, it's not hard to understand that, because all of us have taken out a car loan, a mortgage, and so we sort of get how interest rates work. But how does a revenue-based financing deal work? Take a minute and explain that.
That's a great question. And there's benefits, for both the issuer, the company that is providing that revenue share opportunity, as well as for the investor. So the way a revenue share note works is typically you will have two big components to it. You'll have what's the revenue share percentage. Let's just say it's 5% in this example. And then typically there's the payback multiple, which is like, what's the most that you'll get paid out where you're then settled? So let's just say that's 2x for this example. Now, what that means is that for a company that maybe has uncertain revenues or isn't sure if they're going to be able to make consistent month by month payments like you would for for your mortgage or your car payment, this basically allows them to scale how much you receive as an investor based on their revenues for that quarter or that month or whatever the payment period is. So, for example, let's say there's a restaurant and maybe it's cyclical because let's say you get a lot more customers and people coming in the summertime and maybe fewer in the wintertime. What that looks like, if you picture their revenues over the time course of a year, you'll have fewer revenues in those winter months and then a spike in revenues in the summer months. So what this actually does is will scale how much of that revenue is shared with investors depending on how much they're bringing in. So then investors will be getting, say, 5%, just as an example for a revenue share. Over those summer months, you'll be getting a lot more money back, whereas you'll get 5% still during the winter months, but that will be from a smaller base. What that does is it gives more flexibility to the issuer, to that company, to be able to have that revenue share scale based on their revenues that are coming in. Now, the other thing to be aware of is that you do that and maybe it's set for a certain term length, maybe it's 3 to 5 years. But let's say they crush it. Let's say they are doing super well, they do amazing, and they are way over their projections. And basically they give everyone 2x their money in the first year. What that does is you then hit this revenue payback multiple cap. So that's that 1.4x to 1.5x number we were kind of showing that you would need as a minimum threshold. Once you hit that, it says, okay, investors, we gave you back 1.5x your initial investment, 2x your initial investment. That ends the deal, right? So you're basically paid off at that point in time and it ends. So it can be very beneficial where investors could actually get paid off much faster, much ahead of schedule. But also the flip side of that, right? If the revenues are a little bit slow to get started, you could take a little bit longer to get paid off. So there's the pros and cons as with anything, right? You're not going to get consistent month by month payments. But if you believe that the company has potential where they will have that revenue growth eventually, it can give them more flexibility and can potentially work out in your favor as well.
Yeah. Let's jump back into the data. I appreciate you educating us on how these revenue-based deals work. It's just fascinating and important. Let's talk about this next chart. What does this one mean? I'm explain this chart. I see that, again, 5 bars and a line. What's going on here?
Yeah. So let's focus on the purple bars first, which represent the failure rates to date of different companies depending on their revenues. So you can see that first bar there in purple is pre-revenue. It's about 5.5%, let's call it. That means that to date, 5.5% of the small businesses that have done debt or revenue share offerings have gone out of business or had some trouble, right? So this means that those investors were probably not paid back in full, if at all. Then as you kind of step along the axes there, you can see the next bucket is up to 250,000 in revenue. So again, these companies are now bringing in a little bit of revenue, and you would expect them to be, a little bit de-risked because of that. And you can see the data show that there's about 3.5% failure rate to date for those companies. And then same thing for the 500,000, the 250K to 500K bucket, about a 3% failure rate. And then jumping all the way to the $1 million bucket, these are very mature companies right at this point, bringing in $1 million per year, about a 1.5% failure rate. Now, there's a couple caveats just to that purple bar, to that failure rate. First is these are failures that we are aware of to date. So KingsCrowd tracks a lot of the companies that go out of business, but sometimes companies shut down quietly or don't make a big publicity. And sometimes it can actually take months or even years to kind of wind up and dissolve a company. So these are just a representation of the failures that we know of to date. That number is probably a little bit higher because of some of those companies that, again, are just quietly shutting down. In addition, companies may be delinquent on payments or late on payments, and we're not capturing any of that data today in this. So this is really just looking at raw companies that have gone out of business that we know for sure. So because of that, and we can kind of see later in the analysis, we're going to put a little bit of a conservative margin for error in there to make up for some of those unknowns, because we're using this as a proxy to essentially say these people aren't getting paid back as investors, but there's probably a few other companies in there as well. Now, that's the purple bars. Yep. So failure rate.
So some of those folks that are paying late are probably also paying fees and accrued interest, so that the total returns may be preserved in the long run, even if the company is paying late. It can be uncomfortable if you're trying to live off that money, like trying to live off the rent or covering other debts. So you got to be careful about where this money's coming from. But
Absolutely.
You could get your total return in the end, right, off a slow payer.
Yep. And again, depending on the companies, when something gets, charged off, it may be handed off or to a collection agency. And at that point, they're trying to get, pennies on the dollar back from someone who maybe hasn't paid. So there's going to be the whole spectrum of people who are paying on time and everything's good, to people who are maybe a little bit late. Maybe they make up or catch up with some late fees, to people who unfortunately either go out of business or, are late and then aren't able to catch up. So that's what, again, investors need to think about when they're investing in these
Full spectrum.
Yep,
Yeah.
the whole spectrum. So that's
so tell us about the green line.
Yeah, that's going to the green line. Good transition. So basically what we did is we took that failure rate for each company, and then we calculated the required interest rate at each of those failure rates, plus some of that margin factor that I had mentioned. And also basically what we did is we took in the risk-free rate. So assuming that today investors could put their money into a savings account or invest in, US Treasury notes and get somewhere around 4.5% or 5%. So we took that and then we added that to the failure rate in an annualized basis and added in some of that margin. And that's how we come up with this required interest rate at each revenue bucket that would be required. So you can see again, the pre-revenue one, it's around that 11.1% that we showed before. The second one here is showing, around 10.5%, and then it goes down to around 9.8, 9.9% for the highest one. What that means, right, is again, for the expected failure rates at each of those different revenue stages that a company would be at, you're trying to look for roughly that range of returns to be able to compensate. If you hold a diverse portfolio, right, you don't invest in any one single deal, but if you have a diverse portfolio of holdings, then over the aggregate, over the current market conditions, that's what one might expect to get.
Yeah, I think that this is so incredibly helpful. Really, really helpful. Let's go on to your next chart here. This is, you call this one an expected break-even interest rate versus failure rate. Explain what you see this. What is this chart telling us?
Yeah. So thinking about the chart that we just showed, right? We showed what the failure rates have been to date that we know of in the data. So it was around 4.5 to maybe 5.5%, right, of the failures at the different revenue stages. This is basically saying, let's assume that there's more of these failures out there, the late payments that we don't know of. If you wanted to be conservative and say, okay, instead of that 4.5 or 5.5% failure rate, let's assume that 10% of all the companies will fail or be late. Or then what if it was 20? What if it was 30? This is basically a sensitivity analysis where if you want to be more conservative in the numbers, it's showing you the impact of different failure rates and what the interest rate would be. So the green line here is showing you kind of that base rate of 4.3% that we use for the analysis, which is the 10-year treasury yield at the time we ran it. And then above that is just the risk factor that's on an annualized basis. So if you take 10%, for example, the math essentially works out to around, I believe it was around 1.7% additional risk that you need to be able to be compensated for that interest rate. Now, this does not include, in the prior chart, we were showing, you need interest rates around 10 to 11%. That included an extra 5% buffer that we had included as kind of a risk premium, because when you invest in these deals, your money's going to be locked up for potentially 3 years, 5 years, 7 years. There's risk, there's tax implications. So there's kind of an additional buffer you need to demand in terms of the risk premium when you're investing in these deals. But this is just saying, let's just take a look at the raw failure rates and the interest rates from treasuries. And then this shows you how much, if failures jumped another 10%, you're looking at about a 2% increase in interest for each additional 10% in failures that we're showing here.
Okay. Listen, we've got to take a quick break, Brian. So listen, folks, we're here today with Brian Belley, Vice President of Product at KingsCrowd. And he's done this profoundly important analysis of interest rate returns required for debt deals in regulated investment crowdfunding. It's just vitally important stuff. We're going to take a quick break, but when we come back, we'll continue this discussion to learn more. There's so much more to cover, so hang with us, okay?
You can get in on the ground floor to help fix the climate crisis for as little as $100. Pause now to scan the QR code to get started, or visit s4g.biz/raisegreen. You can beat a green at Raise Green.
Want to learn from the world's great change makers? Find your superpower. Subscribe to the Superpowers for Good newsletter at superpowersforgood.com. Make your strengths into superpowers that will change the world. Join the super crowd today. Superpowers4good.com.
Hope to raise money from the impact crowd. Good investors are as interested in community, social or environmental impact as you. Connect with Funding Hope, an SEC-registered FINRA member crowdfunding portal to learn how to raise capital from the impact crowd. Scan the QR code now.
Welcome back, everyone. Today we're here with Brian Belley. He's talking to us, helping us understand the required returns on debt, how to price, how to think about the rate at which we lend money in regulated investment crowdfunding. Just so important, incredibly important. Brian, thanks for being with us. Appreciate you hanging in. Let's get back to your data. This is just such great data. I want to just take a look at this. Let me just pull this up here. So this scatter chart, what is this scatter chart showing us? I see a red line, a green line. What do we learn from this?
Yeah, so one of the questions that we wanted to look at was, in recent history, remember, if we go back to kind of the 2020 to 2021 timeframe, the Fed at the time that kind of sets the Fed funds rate and the interest rates had dropped it to 0%, right? If we remember the COVID era. But slowly, and then not so slowly, in 2022, they started raising the rate. So what we wanted to actually look at was, did that rate, the Fed funds rate, and that ramp up when they were increasing it to nearly 5.33%, I believe, did that have an impact on the interest rates of deals that were being offered? So what you can see here is each purple dot on this chart is a deal and the debt interest rate offered on that deal. The timeline is the axis with the month and the years on the x-axis. and then that interest rate is on the y-axis. And then that green line is the Fed funds rate. So you can see that in roughly middle of 2022, the Fed started increasing it, and then it kind of leveled out to where it still is today, around that 5.3%. So what the red line shows is basically that is a trend line through all of the purple dots to just say what's the average, just doing a simple linear approximation here. What's the average of all of the debt deals that were being offered of their interest rates? And you can actually see that it starts in around the same time of mid 2022, a little bit below 10%, but it actually finishes in July of 2024, which is when the data went through, at just above 12%. So indeed, there appears to have been an increase in the interest rates of the debt deals that were being offered during the same time that those interest rates, that the Fed rather, was increasing the Fed funds rate.
And there's talk now of these interest rates starting to come down as early as next month. It'll be interesting to see. I expect we'll see the interest rates falling here. So it may be a little more challenging for us to invest with those same target returns if interest rates fall. Interesting discussion. Okay,
Exactly.
let's move on. I think we've got just one more slide here. This is fascinating. This is the returns by portal, the interest rates. And this is just fascinating. Tell us about what you learned here.
Yeah. So this chart is showing the average interest rate across all deals for each of the different funding platforms. There is a big disclaimer to make where many of these bars may actually be a very small data set. So for example, I can tell you the first two shown here, Untold and Oversubscribed Portal, only had one deal each. So they look like they're much better than the other platforms at 14.5 and 13 or 0.7%, but they actually only had one offering. So if you're taking a look at platforms like Honeycomb, which is the third bar there, SMBX, which is around that 10% interest rate, WeFunder, and some of the other ones, those ones have 10 or dozens of deals. In the case of Honeycomb, many dozens of deals. So that's actually a much better representation of the average. But what it shows, right, is you can kind of take a look at this and say, okay, a lot of the different platforms may have different types of offerings, but for the most part, a lot of them do tend to fall between that, let's call it 8 to 11% range there. Now, again, some on the smaller end, there may be other things going on with those. It again, could just be one certain type of deal. Also, it could be the structure of the deal. Sometimes there's different deal terms. So you can't just look at this and say, oh, it's a 4% interest rate. That's no good. There's probably some other things that are going on with that.
Yeah, a lot of those portals on the right part of the chart have social mission, right? They view themselves or can demonstrably have impact. So like you see Climatize kind of at the beginning of that right-hand side. You see Raise Green. You see Crowdfund Main Street, Crowdfund Montana, Crowdfund Baltimore. All those are websites that have kind of a social mission as part of their pricing. And so they're clearly pricing that in. Brian, it's also true that some of the portals use different approaches for pricing. So it seems to me that WeFunder, Crowdfund Main Street, some of these, I think Raise Green is pretty much allowing issuers to set the price and terms. Whereas SMBX and Honeycomb, I think they're working with their issuers and telling them where the interest rates need to be sometimes. At least I think SMBX does that on every deal. What's your understanding?
Yeah, that is an excellent point, because I think if we had looked at some of the data for, okay, this is where the interest rates were at, but how did those companies actually do in reaching their minimum goal, or how much did they raise? I suspect that you would perhaps see, right, some of the ones that are maybe in the more of the fair range for the investors were performing better for raising the capital. Now, again, this is not, this is a very broad statement, right? We're kind of looking at aggregate level data here, so it's really going to vary if you look at any one individual deal. But as a whole, I agree that some of the platforms that work more with the issuers to set that rate for what's going to be fair may end up doing, better, because investors are going to look at that and say, yes, this makes sense. I need to compensate for the risk that I'm taking. And again, this is not to say that some of the other ones on the lower end of that chart aren't going to do well, because there are a lot of those people who are really impact mission driven that know, maybe it's the microbrewery down the street that I really want to succeed because I want in my community.
Yeah.
I'll accept a 4% rate for that because I might be getting something else tangible. So,
so here, let me share. This is the link on the screen here, s4g.biz/KC debt, KC like King's Crowd. That's the link to Brian's original post. That redirects to Brian's original post about this. You want to read that. Brian, thank you so much for being with us today. We really want to wish you every success in the great work that you're doing. And thank you so much for being with us today.
Thank you, Devin.
All righty, let's do some good.